Many traders prefer to get involved into low time frames and to make quick profits scalping Forex or stock markets. Other are price actions traders, reading the markets and making trading decisions based on the recent price movements. Not replying to the technical indicator, but can you combine both scalping and price actions? Sure, you can. And in this video, I'm going to show you a simple price action strategy to scam the lower time frames. Strategy which involves trend line and a double top or a double bottom pattern. Just as the name implies, this price action patterns involves the formation of the two heights. At the vertical resistance level for the double top and the formations of the two lows at the vertical support area. The idea that the make was rejected from the level not once but twice. In these indications that the level is likely to hold, a double top pattern is where price fails to break previously established price level. This indicates an area of the resistance where sellers overwhelmed the market. As a result, the buyers eventually give up lending and double top pattern. A double bottom pattern is exact opposite of the double top pattern. Here's price initiality forms a low and the bonus backs. Following this bonus, price once again tests the same level but fails to break any lower. The double bottom patterns indicates an area of support and demand where buyers overwhelmed the sellers, leading to the price forming this pattern. A validation of the patterns signals the relevant in the price directions. When these patterns from it tells you that the market momentum in the directions is staying, when the price falls to make any fresh lows or highs but close at the near previously established height or low double top or double bottom patterns is formed. In this 1 minute chart you can notice that after the double top pattern is formed, price tends to eventually move longer. And here you will see the double bottom pattern that emigrates as successful formations of this double top or double bottom pattern results in the chart price directions. Now here's the important point. Not all double top double bottom patterns are perfect. In this very rare to find price formations a pattern at exactly the same price level. A more common pattern is the double top or double bottom with the fake breakouts, especially on the lower time frames. Take breakout patterns are one of the most important price actions trading patterns to the learn because a false break is often a very strong clue that price might be changing directions or that a trend might be resuming soon. A false break of the level can be thought of the deceptions by the market because it looks like the price will make the strong move in one direction, but then it quickly reverse, deceiving all those who took the bait of the breakout. It's often the case that management will enter what looks like the obvious breakout, and then the professional will push the market back the other way. As the price actions trade, you wanted to learn how to use the double top and the double bottom false breakouts to your advantage, rather than falling victims to them. One common misconception is the double top or double bottom patterns because tradable once the second top forms. The truth is that the double top or the bottom is only confirmed that therefore traveled once. The market closed below the neckline. This is intermediate height in case of the double bottom patterns, or the intermediate low in this case of the double top patterns. When this resistance point is breakout, you can expect the pattern to be validated. Once the pattern is formed, the price now change directions. When you combine these patterns will be concept of trends. This approach will be even more powerful. Now, what be an understanding of the double top or the double bottom patterns? Let's see how can apply to this scalping. Most trading books teach you to trade double stops and double as the reversal patterns. I prefer to do the opposite. I trade them continuous patterns. Yes, a double bottom or the double top when deformed within the trend can signal continuations. For this approach, you will first need to determine the main trend and the lower time frames, and plot a trend line and upward trend line when you see the higher heights and the higher lows, and the downtrend trend line when the market makes lower lows and the lower highs. Now you need to identify the potential setups such as the double bottom or the double top pattern that can occur close to the trend line. When this pattern emanates, you can be confirmed in the trading in the direction of the trend. So in the case of the upward trend line, you search for the double bottoms near the trend line. And conventionally, you search for the double top patterns near the downtrend line. Let's look at the example of the long setup. In this instance, we identified the risk and trend line on the 5-minute charts, and we waited for the price to post a double bottom pattern. This pattern forms right near to the trend line, increasing the volatility of the double bottom patterns. Since we already known that price is uptrend, the validation of the downtrend bottom pattern of the trending line, increasing the odds of this setup being successful when compared to the trading it in isolations. You enter once the price breaks above the neckline of the double bottom. Now, the first thing you need to know is that the initial breakouts is not what triggers the trader to the trade setup. What we need is the resets of the necklines as new support. This insurance formidable risk to reward ratio, which is an essential factor if you wish to succeed when scalping. Notice in this example how the market retests the necklines as the new support. In this, where we now have an opportunity to go long, a potential profit target is made by the projections, the distance of the double bottom to the upside. You simply take the distance from the double bottom resistance level to the neckline and extend that some distance beyond the neckline to the future upper point in the market. You don't necessarily need to wait for the DT or the BD patterns to form right near the trend line. These patterns can appear at any point in the uptrend. The key thing to remember is that the trend line still remains intact and that price has not deviated too far away from the trend line. This is because when the price deteriorates too far away from the trend line, it can revert to the mean or the snap back to the trend line. This can reduce the odds of the double top or the double bottom patterns being a successful trade setup. Here's an example. of the valid double bottom near upward trending on the lower time frames. The second scalping scenario involves a downtrend trend line and a double top on the lower time frames. So let's analyze this example. We have the downtrend trend with the bearish trend line. The price creates the first top and the markets another top. Notice that the created patterns is near main the trend line and doesn't go through it. The plot to the neckline on the bottom between the two tops of the pattern. You go short when you identified the breakout and price resets the neckline. Nevertheless, to say you should always secure your open trades with a stop loss order, because there is never the guarantee that the trade will work in your favor, especially when you are the scalping. The optimal place to put your stop loss order is just above the second top. If you want the higher risk reward ratio, you could set your stop loss closer to the entry price. For example, you can put your lap lows at the another smaller sweeping points or the candlesticks heights, which comes after the second top. In the price move after the neckline is the consistency with the corrections, then simply measure the distance between the second top and the trigger line and place your top loss in the middle. It might be a better risk reward solutions for the double top and the double bottoms. This way you will get at least 1 to 1.5 risk reward ratio. After setting a stop loss, you measure and apply the size of the double top patterns as your target. So the medium trade equals the size of the pattern. Now here's the very important point. A double top patterns without the close below the necklines is not technically a double top unless the neckline has been broken. This is not a double top. It could be a consolidated ranging price actions. The main thing to remember is that the double top is completed until the market closes below the necklines. Not only is it not completed, but attempting to enter before having the confirmed setup can get you a lot of trouble. Perhaps the most important aspect of the double top is avoid entering before confirmations. Wait for support and to the break-in in the convincing measure, and usually within expansion of the volume. Yes, you can pay attention to the volume to get extra confirmations that the breakout of the necklines has some momentum. Here's several very double stops near a bearish trend line. Most traders use indicators for the scalping, and this is not the wrong with the approach. The problem with the indicators is that they lag behind price, and scalping trading and the lagging behind just don't mix well together. Scalping requires quick analysis, quick decisions, and the quick trading. That's why the price actions presents a good fit for the scalping. At its core, price actions trading is about the speed of the effectively and might bring better and more consistent results in the long term. As always, if you find learned something new and find value, leave us a like to show your support, subscribe to the channel, and hit the bell icon to stay notified when we upload next video. Until next time.